Saturday, January 11th, 2020, Monaco 64, home of alternative economics and contrarian views. Today I want to talk about how the Bank of England and the UK Treasury have intensified their war against the British pound. You might think that's strange and weird or extreme, but this war has been ongoing since the '08 financial crisis, when the pound reached a high of 211 versus the dollar, and the pound's been debased ever since. We're now around 130. Interest rates have been kept almost at zero. The Bank of England has created almost 500 billion pounds out of thin air to buy bonds and other assets to keep interest rates low and to keep this inflationary bubble going. And why do they need to keep interest rates low? Because if they allowed interest rates to go to the normal level that the market, a free market, would set, the whole bubble would implode. So why have they intensified this war against the pound this week? Well, there's been a few announcements. One from the Treasury, not really an announcement, but through their actions, we're seeing that they're going to go get the bazooka out and inflate the system through fiscal policy. Those of you who think that with Boris Johnson in power, things are going to get more sane, that we're going to have an economic miracle, think again. And that's why I keep telling my viewers, at least it's what I'm doing. I continue to protect my savings with precious metals, with gold and silver. If you're able to do that, I think it's a good thing, because all that's going to happen to the pound is that it's going to keep devaluing, especially against gold, which is the most stable store of value for the last 3,500 years. Against the dollar, the Americans are doing the same thing. Their deficit spending is even bigger than the UK's. The Federal Reserve is even more accommodative than the Bank of England. So yeah, the pound might do well relative to the fiat dollar, but versus precious metals, watch out. I would say that in 5 years from now, if you have £1,000, for example, in the bank, and you leave it there in a savings account, you might have a little more in 5 years, maybe 1,030 or something like that. But the purchasing power of those £1,000 is going to be probably like 800 or even less. So it might not look like you lost anything, but the purchasing power is going to be lost. So let's go to the first story, the fiscal side of the equation. This article came out the other day, January 7th, in the FT. Of course, the FT reports the article. They don't really look into what it really means in a deeper sense, like I'm looking. The article says, borrowing bump sets up UK as test case for bond market. Mild market reaction suggests investors are resilient to extra fiscal spending. The way the bond market is reacting, which is kind of the theme of the story, is not important. What I want to show you is how they've really put the foot to the pedal, and they're going to start spending like drunken sailors again. And why do I say again? Well, because I remember very well in 2010, Chancellor George Osborne said that he planned to balance the budget and have a budget balance, 0% budget deficit by 2015. Here we are in 2020, and we're nowhere close to that. And we're getting closer and closer to a recession, because business cycles exist, or credit cycles. And expansions don't last forever, and this one's long in the tooth. So we need to think about that. And when the recession happens, it's going to probably get even worse, the borrowing and the deficit spending. So this is what the article says. Boris Johnson's borrowing spree has started early. Officials in charge of managing the UK's bond issuance shook that markets from the New Year slumber on Tuesday by announcing an extra £14 billion of gilt sales in the current fiscal year, which runs to the end of March. You might think 14 billion isn't that much, seeing that the Fed does intervenes to the tune of 100 billion in the repo market daily, but for the UK that's quite a lot. If you look, for example, at the forecast for the budget deficit this year, in 2020, it's 21 billion. So he's adding an extra 14 billion to that forecast of 21 billion. So it's a big amount. It's quite significant. I'll continue. The scale of the increase, which bumps up gilt issuance for the full year to 136.8 billion pounds, clearly took investors by surprise, generating a dip in UK government bond prices at the start of the day's trading. So the article goes on about talking about whether the bond market will be friendly to the government, even though the government has started borrowing a lot. So far, the bond market is still giving the government the benefit of the doubt, so to speak. Interest rates in the UK are still very low. The 10-year yield is less than 1%. And the only reason that is the case is because the Bank of England is on the other side saying they're going to keep rates low for as long as the eye can see with their forward guidance. That's what forward guidance is. So bond investors, they have the incentive to keep buying these government bonds, because don't forget, when yields drop, bond prices go up. The only problem with this strategy is that if you're a pension fund, if you're an investment fund, and you try to provide income for your investors and retirees or pensioners, there's very little income there. So they have to leverage everything, and that's always very risky. Of course, the other thing that more bond issuance or deficit spending does is that it increases the money supply. It dilutes the existing money in circulation, and that's what inflation is. It's a little bit like a rights issue when a company, a corporation issues more shares of their stock, usually the share prices drop. So all this means is that the value of a pound is going to keep dropping versus real things. Things that can't be conjured up, like debt by politicians. And don't forget as well, nowadays, fiat currency, the other side of the fiat currency is the debt, is the government debt. That's what it's backed by. So that's the fiscal situation. Here we are, 10 years after Osborne said the budget deficit would have been balanced by 2015. We're still running, probably is going to be 2% or more this year. It's probably going to increase thereafter. And we still haven't had the recession yet. And in times of recession, governments kick in the spending. So I personally don't think the fiscal situation is great for the UK. Yes, it could help sectors of the economy, especially the City of London, the financial sector, of course. But in terms of the health of the real economy, I don't really see it getting any better. Yeah, it might feel like what central bankers used to call a coup de whiskey, a shot of whiskey that improves things, gives you a buzz, but the hangover is not great. So that's what I think is happening. It's not a really organic growth that we're going to get. It's going to be inflationary. Of course, we're told these days, especially by the central bankers, that we have a problem of low inflation, which is codswallop, as the English would say, or rubbish, basically. So now let's go to the monetary side, the Bank of England side. Of course, Mark Carney, he's still around. His term ends on the 16th of March, 2020. So he's still got a few months. He's still in charge. And I think he's quite influential. Is it Stephen Bailey? I think he's taking over as governor. I'm sure he's going to not rock the boat that much. He's not going to come in and start raising rates and say, oh, we need to nip inflation in the bud. No, he's going to keep to the script of that we have a problem of low inflation. And I ask the people living in the UK, like I do, when was the last time your utility bills went down? When was the last time your train fares to work went down? When was the last time your council tax went down? When was the last time food prices went down? You get you get my gist, right? So let's go and look at this article. This is also from the FT. The title of the article is Carney says BoE could commit to lower for longer rates strategy. So that's the forward guidance. They're not really acting upon it. They're not really doing it through QE, but they're just like trying to tell investors, don't worry. If rates start going up, we'll come in to rescue you guys. So keep buying bonds to keep interest rates low. So it says here, governor floats keeping policy on hold until clear evidence inflation is well above target. So you see the Bank of England and the government, they're not happy enough that the average person in the UK, the general public, is not suffering enough. They're not like having a tough time already, enough of a tough time already paying their bills. They want you to suffer even more. Of course, the people at the top, they protect themselves against inflation. CEOs of the big UK corporations, I read the other day, they make 119 times more than the average worker in their companies. So they're not concerned. They will buy into this low inflation mantra because they want also to see this credit bubble continue. That's the only reason why they keep saying that inflation's low, so they can keep inflating, because if they don't keep inflating, the house of cards collapses. So let's go through this article. It's by Delphine Strauss. Actually, it was from a couple of days ago. The Bank of England could commit to delay any interest rate increase until inflation is well above target as a way of injecting extra stimulus into the economy, the outgoing governor suggested on Thursday. One thing I like to say about inflation, they consider inflation nowadays the CPI. Of course, the CPI is heavily doctored. The calculation and the way they do it is supposed to keep it really low, because that's the scam. They want to inflate the money supply as much as possible. If they publish the real rise in prices, gilt prices would be a lot lower, interest rates would be a lot higher, and the whole thing wouldn't keep going. There's the other measure of RPI as well. They don't use that anymore, and that's about 1% higher than CPI, so they're not talking about RPI. So I'll continue now. Mark Carney said there was an open question as to whether the UK's monetary policy framework should be adjusted to embed a commitment to hold rates lower for longer in order to tie policymakers' hands and make the commitment to delay liftoff credible. One option, which would involve only a modest change to the current framework, would be to adopt a whites of their eye strategy in which policy remains on hold until there's clear evidence that inflation has returned sustainably to target, he told a conference in London. I'm sorry, Mr. Carney, all you need to do is come out in the suburbs or wherever where normal people live to see how inflation is really running more like 5 or 10%. Your phony 2% inflation is just that. The bank's inflation target is 2%, but in November it was 1.5%, the same as the previous month. A stronger variant would be a temporary change in the inflation target or a move to average inflation targeting, requiring policymakers to make up any period of low inflation with higher inflation in the future. But Mr. Carney suggested this might not work in the UK because swings in the exchange rate have a big effect on inflation and could lead to perverse policy decisions. So I'm going to stop here. My conclusion from reading these two articles is that the general public is going to continue to suffer. We're going to continue to have stagflation in the UK. The reason why they say that inflation is low is because they don't really look at inflation, because the true definition of inflation is the increase in money and credit, the abnormal increase of the money supply resulting in higher prices. But when you call the consequence of inflation, which is higher prices, inflation itself, and call it CPI and fiddle the CPI, yeah, you can fool a lot of people most of the time, but you can't fool everyone all of the time. So that's my view here. It's not going to get better. It's going to feel like the economy is doing better, but if you really look underneath the surface, you're going to see GDP higher, but you're going to see higher budget deficits. The general public is going to feel it. The cost of living is going to keep going up. And if you do have savings, if you're lucky enough to have savings in the bank, this is not advice, but this is what I've done, is I've accumulated precious metals for the last almost 20 years. I try to do dollar cost average of precious metals, gold and silver. And dollar cost average is basically buying as much as you can once a month or maybe more. You shouldn't worry about the price in the long term. The pound is going to be debased, as you can see, from not only the fiscal side, but the monetary side. If you're interested in accumulating precious metals, I have a promo code, Maneko64, with Gold Investments. Gold Investments have been in business since 1981. It's a family-run bullion dealer in the city of London. Give them a call if you're interested. They can help you. If you need help, if it's your first time, and give them my promo code. I'll put a link below in the description to their website. If you enjoyed this video, make sure you hit the like button. Please share this video far and wide as well. And you can also follow me on different platforms like Twitter, BitChute, Steemit, and DTube. I wish you all a great weekend. Take care. Bye.